Ladies and gentlemen, good day and welcome to the Medicure Q3FY22 Earnings Conference call hosted by ICICI Securities Limited. As a reminder, all participant lines will be in the listen-only mode. There will be an opportunity for you to ask questions after the presentation concludes. Do you need assistance during the conference? Please signal an operator by pressing star and then 0 on your touchtone telephone. Please note that this conference is being recorded. I now hand the conference over to Mr. Mitesh Shah from ICICI Securities. Thank you, and over to you, sir.
Thank you. Good afternoon, everyone. On behalf of ICICI Securities, I welcome you all to Q3 and 9-month FY22 earnings conference call of Medicure Limited. We have the senior management of the company with us today, represented by Mr. Himanshu Baid, Managing Director, and Mr. Naresh Vijay Veragya, CFO. With this, I will hand over this call to Mr. Baid to the opening remarks. Over to you, sir.
Thank you very much, Mitesh, and thank you and good afternoon to everyone who joined the call today for Q3 earnings call for Medicure. First of all, I'd like to apologize for the delay in the call, as both my parents were down with COVID and only just a couple of days ago they became negative, and we had some issues, so as a reason I had to take care of them. But now we are here, and I'd like to appraise you of the company's performance for Q3 and 9 months so far, and then take you through some highlights, and then from there, we can then have Q&A session from our investor community and friends. So in Q3, if you see, the revenue increased from 194 crores to 220 crores. There's around a 30.5% increase. But there was a drop in EBITDA margin from 28.7% to 23.2%, and mainly due to impact of sharp raw material price increases, supply chain disruptions, and inward transportation costs. And if you see the total increase in raw material over last 1 year, whether we are comparing 1 year ago quarter, there is an increase of around 50% in all critical raw materials, whether it is plastics, whether it is chemicals, whether it is paper packaging material. So there is a massive increase in the pricing. We have managed to get price increases from most of our customers, and it is still in progress. But if we actually see the real impact of raw material increase on our business, if we had no increase in pricing from our customers, it would have impacted the margin by 12 to 14%. But because we had an ability to get price increases from customers, and many contracts have that provision, and it is still a work in progress exercise, we were able to only have a 4 to 5% impact on the profitability. If you look at 9 months revenue, revenue has increased from 544 crores to 635 crores. There's an increase of 16.5%. We maintain our guidance for 17 to 18% growth for the whole of FY22 with a consistent quarter-on-quarter growth. EBITDA margin change over 9 months is it has dropped from 28.5% to 24.5%. So overall, there is just a 4% drop over the year, 1 year. But again, the reasons I've explained, just a few seconds ago, those are the main reasons. But the absolute numbers, there's a PAT increase from 92 crores to 107 crores. So there's a 15% increase in the PAT. We expect to end with the EBITDA margin of 24.5% to 25% overall. So in 9 months, we have done 24.5%. So we expect that this quarter, we will have around 8 to 10% of quarter-on-quarter growth over Q3. And with that growth in mind, I think there will be a small improvement on EBITDA margins. So we should end between 24.5 to 25% overall for the financial year FY22. In Q3, the domestic business has contributed to around 34%, and exports has contributed to around 66%. If you look at 9 months, the domestic business, which was 32%, has grown to 35%, and exports has dropped from 68% to 60%. So in absolute terms, domestic business has grown over 30% in 9 months, and export business has grown around 10% in 9 months. And the major reason for exports not growing is because of a huge shortage of containers globally, and we see a huge delay in getting these containers to ship products to our customers worldwide, because Polymed has customers in over 110 countries, and it's sometimes, we are finding very difficult to get containers in time and ship the products. And even the freight cost has sometimes quadrupled from the original level 1 year ago. So that is also kind of delaying, customers, from getting containers in time. Sometimes they want to, have their own nomination for shipping companies. So they are trying to renegotiate the prices, and that also causes a delay. But we expect, currently what we are seeing right now, this problem should still continue for 4 to 6 months of this container shortages. And I think it is across the industry, not only a Polymed specific issue, but it's across the industry. But we are trying to find best solutions and trying to move on. So this year, that's the reason there will be a muted growth for exports. But on the overall scenario, if we see, I think the domestic business has grown quite well, and we hope that will continue with the same momentum. Company has received a second PLI scheme approval for the diagnostic sector. So for every incremental sale we do 1 crore in diagnostic business, we will receive a 5% incentive from FY22-23 onwards. This is additional to the first PLI scheme approval received by the company for dialysis products, where again by meeting minimum threshold levels in sales, we will receive 5% incentive from FY22-23 for 5 years. In recent union budget, government increased duty on dialysis products from 0% to 7.5% plus health cess, bringing them at par with other medical devices. This is a big boost for Polymed, as this will make our products more competitive in the domestic market. There are only 2 companies in India making full dialysis products, and Polymed is one of them. One is a Japanese multinational company. And we were both suffering because of zero duty of these products, and there was a huge, dumping by Chinese companies for Indian market, and there was also no quality standards for this product defined. From 1st November 2021, all medical devices have now been designated as drugs, and you need a license or a license application to import the products. So with that in mind, and plus the duty structure coming in for dialysis products, I think we will have a lot of advantage now to push up revenue for this business and take advantage of PLI scheme. And PLI scheme becomes operational from 1st April 2022. So whatever revenue, incremental revenue we do every year, the target is 60 crores. If we do an incremental revenue of 60 crores in dialysis products, including export revenue, we'll receive a 5% incentive of that. We are also giving a guidance for Q4 revenue, which will be around 8 to 10% growth over Q3. And this is what we see now. We are already 1.5 months already in this current quarter. So we should be able to achieve a growth of 8 to 10% over current past Q3 quarter. For FY23, we will see a margin improvement of 200 to 250 pips due to price improvements from customers, some contribution coming from incentive schemes, and growth in export revenues in excess of 12 to 15%. Because currently we see export revenue in current financial year by growing only 10%. But with the new contracts we have received and new customer additions we have done in last few months, we are seeing expecting a growth of around 12 to 15% in export business in next year. So with that in mind, I think we are looking at a margin improvement of 200 to 250 pips during the financial year 23. Revenue guidance for FY23 is approximately 20% over FY22, as new plant in Faridabad and in SEZ Jaipur will become operational by mid of FY23. So we will have partial, manufacturing starting in this plant by mid-year, mid of financial year 23. So that will also add to additional capacity and also lead to some growth in revenue. So we are expecting a higher growth in FY23 compared to FY22. From 17-18%, we should move up to around 20% and over in FY23. To keep this expansion momentum continued, we are investing in one more new facility which will be operational in FY24-25, and land for this new facility has already been secured, and we will be doing some backward integration and some forward integration in this plant. And this is mainly for sterilization and other activities related to dialysis business. For our US business, our applications were made in July, August last year. We are expecting, we had some queries, but we are trying to resolve these queries, and I think hopefully by April we will send answers to all our queries, which require some additional testing of the products as per US FDA requirements. and we expect that the first approval should come in June, July of 2022. There's a delay than what we had anticipated earlier, but I think due to current COVID pandemic, the applications have been pending there, and I think they are taking some extra time to review their applications. But we are in touch with some new customers in the US, and with our new R&D head who's based out of Minneapolis, we hired Stephen in September 2021, and with his help, we are looking at developing some new products for US customers. So that process is also on. So overall, I think for US, we have work in progress, but actual results, yes, will start coming. We already have a revenue of around $1 million from the US currently. But I think as and when we have more FDA approvals and more projects rolled out, we expect this business to grow multifold in coming years. Our step down, we are also targeting to enter animal healthcare business in US, which is also very high potential. And most of these products used in animal health are closer to human health business. So I think it's a much easier path to enter, and I think we are already talking to a few companies out there to develop this business. Our step-down subsidiary in Italy, Plan One Health, is also expanding its business, has received new registration in Russia, Brazil, and some key EU markets like UK, Spain, for its oncology range of products. So year 2022 will be good growth year for this company, and we have also done some expansion last year in capacity. So this company, which has specialized in oncology range, cancer care treatment products, should do well in coming years. Europe continues to be a key focus market for exports. So 1/3 of the revenue, export revenue, comes from 6 countries, which is UK, France, Italy, Germany, Spain, and Sweden. So if you see total overall exports of Polymed, from that 1/3 is contributed by these 6 countries, which are very highly developed markets. And basically in these countries, only if you have high quality products, then only you can export. So they are not concerned about price; they are more concerned about quality and efficacy of the product, and whether it meets the clinical standards or not. So I just wanted to inform our esteemed shareholders and friends here that Polymed operates in very highly regulated markets and has a good presence in this market. And we are actually growing our business in this country. In fact, even this year in FY23, we will also see a good growth in revenue in these 6 countries, because we have signed some new contracts with some customers in UK, in Germany, and in Spain, and I think that will also add to more business in this country. We entered the vaccination syringe market in December last year, and we have already received orders from the government to supply to certain vaccination programs. And this was a new product addition which we did in a very short time. In 6 months, we added this product, got approval for this product very quickly from the government, and we have started selling this product. And I think we see that the demand continues, because WHO has already predicted a shortage of 2 to 3 billion syringes in the world. So I think though we entered a little late, but I think we still entered at a time where there's a demand, and we will also increase our range of syringes from safety syringes to, we already do pre-filled syringes, insulin syringes. So we'll have a full portfolio of syringes. And I think that will also help us to increase domestic market play, and also in some countries we'll be able to export this product also in times to come. So we're already working on some new product lines and some new product growth areas in syringe space. We are also entering into some safety needles and allied products, which will help us to even increase our revenue for syringes. We have a robust pipeline of new products for next 1 to 2 years. We are already investing in diagnostic business. We have got a PLI scheme for that. Explained on the last call also, we are already working on cardiovascular consumables business, which includes angiography catheters, thermodilation catheters, balloon catheters, guide wires. India is importing 100% of these products, and we are trying to also look at products which can be import substitutes. So we are working on that. Our dialysis machine, which we are developing indigenously, is under trials right now. And hopefully in Q1, we will be launching a machine which will be fully indigenously developed dialysis machine. So not only we are in consumable business, we are trying to develop our own machines and equipment, and move into the market, and again challenge a market which is dominated by multinational companies. Today, there's a 100% import of this equipment. Nobody makes them in India. So again, a new area for us to expand. And once we see the success of this machine and we see the demand going up, we'll start probably developing more equipments which are allied with our current business, maybe infusion pumps, syringe pumps, which go with our vascular product range, or some equipment related to blood banking, which goes with our blood bag. So this is what our plan is for future next 2-3 years, to expand in the same vertical, but getting it with equipments also, so that we do the full therapy. And when we go to a customer, we are able to offer the full therapy and range of products. And same thing we are going to do in diagnostics. We are starting with some consumables and some kits, and later on we will get into equipment, so that once we go to a lab and approach to sell our products, we'll be able to offer complete solution. So next 2-3 years, the target is to build up a pipeline of products in these 4 ranges where we operate, and try to increase the offering by combining consumables and equipments. Our R&D team is doing a fantastic job. I think what we have heard from the government of India is they are coming with a new R&D policy for pharma and medtech sector. They are trying to bring out certain incentives. The draft policy has already been shared with the industry, and I think though there is no clarity on incentives till now, but Polybit being is an R&D space in medtech field, as you all know, we already hold over 300 patents as a company. So I think for us, we are waiting to have this policy implemented. Maybe in the long run, maybe government offers certain incentives for companies who are developing new innovative devices in the country, or bringing in import substitutes. So we are currently on a wait and watch mode, but we have seen the draft policy which talks about certain incentives but does not quantify them. So constantly, as a company, we are working on new ideas, new product developments, new improvements, and these new ideas help us to deliver a better value and care to our customers, especially patients in the hospitals. We are trying to increase our presence in corporate hospitals, where we are trying to go more deeper in these hospitals by bringing in more products. Today, at least Polymed brand is very well known with every hospital, important hospital in the country. That is what we have done in last few years. We have put a lot of emphasis on brand development, going more clinical, deeper into the clinical part of the business, where we talk about critical advantage of the product and why this product should be used over other competitive products, what advantages brings to the hospital and even to the patient. So these are the things we are adding, and we continue to hire more people. This year we have planned to add another, in FY23 we'll add another around 75 to 100 sales people in the organization across different verticals, whether in clinical side, sales side, marketing side, and product management side. So that is the plan going forward. And now from now, I think I'm happy to take questions from our friends on the call. And I thank you once again for joining this call and patiently listening to me. Thank you very much. Mitesh, over to you.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are also requested to use handsets while asking a question. Anyone who has a question may press star and 1. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question is from the line of Nikhil from Chris. Please go ahead.
Yes, sir. Thank you for the opportunity. I had just one question. Wanted to understand, I did speak to a few distributors on ground. We lack a central pricing in Bombay. I understood probably Gujarat is having some different pricing for the dealer, Bombay is having some different pricing for the dealer. And in Bombay also, Mulund, which is a town, it has got different pricing, Thane has got different pricing, and this is actually distorting the market. We have got a very good review for your products, like Romson. Your products are definitely much better than Romson, but somehow probably due to this price discrepancy, they are not able to probably give it to the market at good prices. So that is what I was just wanting to understand. Why is there a discrepancy? Why can't we have a central pricing like the other players?
So I think this is a very typical question. We see basically pricing depends on customers' buying capacity. So for example, somebody who's buying only let's say 100 pieces for a product will have a different price. But somebody who buys 1,000 or a corporate which does an annual rate contract will have a different pricing. Will have a different, let's say, ability to get a better pricing because of the sheer volume they draw. So I'll take your feedback definitely and see what it's a good feedback that has come from the ground level. So we will try to see if there is any discrepancies, So what we are trying to do this year, that's a good point. We are trying to bring with one corporate hospital price list. Currently, every hospital has a different price list because, we get different price increases, different price point quotations are made at different times. So there are different prices which are applicable. So what we are trying to do from 1st April is to have a separate corporate hospital price list. So then any hospital which buys will have one price list, but based on their volume takeoff, they will get a discount on that. And whereas for a smaller hospital or a nursing home, there will be a separate price dictated by the distribution partner who is around in that area. And also pricing depends on the payment terms. A lot of hospitals pay between 6 months to 9 months, the bad ones. Good ones pay in 3 to 4 months. So also the distributors adjust price because on the payment terms also.
Understood. And sir, one more thing. Thank you for thank you for taking the input. One more thing, sir. I wanted to understand. Say, for example, there is a distributor, 3 or 4 distributors in Bombay. Are they not having an access to all the products, and our CNF is having I understood dialysis is available with our CNF and it is not available with the distributors. So wanted to understand the reason for that, because we understand we are the probably only Indian makers of this machine and it has got a good potential. They were just trying to push the product and they were not having access to the product. So wanted to understand, is there a separate strategy
so every distributor has a different skill set. So person who is good in selling vascular product, hospital products is not good selling at products in dialysis centers. So as the business is growing, see in our infusion vascular business now we have appointed multiple distributors in every state. Earlier we were operating through only one distributor. Now we operate through multiple distributors. We're also operating with distributors aligned to one hospital, for example. In dialysis also we are doing the same thing. For every chain we will put one distributor in place because it's very difficult to supply from central warehouse in Delhi or Faridabad. So we are also trying to now bring in more distribution partners in play, and not necessarily there will be same distributor for this for a different range of products. So diagnostic will be separate distributor, bed banking will be separate. So that's how it would work, because you need specialization in every area.
Okay, understood. Great, sir. Thank you for this. I'll get back in with you.
Thank you so much for your question.
Yeah.
Thank you. Before we take a next question, we would like to remind participants to ask a question. You may enter star and 1. The next question is from the line of Devesh from DS Investments. Please go ahead.
Yeah, hi. Good afternoon. Thank you for the opportunity. Quick question on a little longer term perspective. If we look at 3 to 5 years, what are our aspirations to maintain in terms of export versus domestic? I know this year has been a little down on export front, but just wanted to get your thought. Yeah.
See, I think if you see a 3 to 5 year horizon, yes, for us domestic market, and we have a lot of people out here. So we have around 250 feet on the ground versus in exports between India and outside India, we have only 30-35 people. So our focus is definitely domestic market. My ideal situation would be, let's say 5 years from now, have 40-45% domestic business, 50-55% export business. I think that would be an ideal scenario.
Okay.
Because again, export is to 100 countries. So, the market is growing, the product range is growing. So, and the same customer is buying more products. So that will continue to grow, and that is growing, let's say at its own rate. But domestic market is where we are trying to feed with a lot of clinical information, a lot of data, a lot of field work, a lot of doctor engagement, doctor training programs we are doing. So domestic definitely, and as I was explaining earlier, percentages change from 32% to 35% this year. So every year, if we can increase by 2-3%, so I think that will be something is my aspiration today.
Got it. Thank you for that detailed answer.
Yeah.
And in this journey, as we go through, and plus, you called out a couple of PLI incentives and things like that.
Yeah.
I think I didn't catch the margin trajectory from next year to, let's say, next 2-3 years. How would margin look like for us?
PLI is only based on a certain product category, right? So, for example, it's mainly on renal business, which is currently, let's say this year will end around 60 crores, next year maybe around 100 crores plus. So I'm getting on the incremental revenue of 60 crores PLI scheme. So that is 3 crore on the total P&L. Let's say for dialysis. For, let's say, diagnostic, which is let's say 25-30 crore business, I'll get 5% on that. So it is around 1.5. So it's a 4-5 crore input. So which if you look at in the long run, maybe, on PAT terms, it is around 150 pips, 200 pips addition. But we are not factoring in that as a, gain. I think for us the bigger gain is how can we get more deeper into the market with a bigger market share.
Got it. Got it.
Yeah.
So at least we should be able to hold our, the past margin trajectory because
that is the whole idea. That whole tipsy-turvy situation in raw material pricing is kind of really crazy right now, with crude also hanging over 90, so all plastics get impacted, all global supply chain is impacted. So we have protect our margins, get a price increase from customers. So we are doing our best. Hopefully we can get back to that happy situation of 27-28% again.
Got it. Yeah, understand. Totally understand. And the second was dialysis equipment sounds really interesting. In your opinion, what is the opportunity size and, again, over midterm, what are our aspiration as market share?
Yeah, so I'll tell you the market size. So India currently, if you look at last 2 years data, and currently there are 40,000 dialysis machines operating in India as per the information we have.
Okay.
And every year we are adding 3,000 to 4,000 dialysis machines, maybe 3,000, and average life of a machine is around 10 years.
Okay.
So on that there is redundancy, then there is a new machine addition. So we are looking at around 3,000 to 4,000, 5,000 maybe, and once the market gets better, because a lot of patients went off dialysis during COVID times because of infection and they are low on immunity. So if they visit dialysis centers, they catch COVID. So, a lot of people were not even taking dialysis treatment. So I think once COVID gets over, the dialysis will take off more further. And with government program of Ayushman Bharat, 1,500 rupees reimbursement happening and reuse slowing down. Because today in Mumbai itself, there are 10 to 12 times use of a dialyzer in a, let's say, charitable institute. Because they are trying to lower the cost by reusing the product, which is completely prohibitive, not even allowed. But they are doing it just to reduce the cost. So in my view, there's a market for 3,000 to 4,000 machines. So even if we get 10% to 15% market share, let's say in 2-3 years, that will give us a runway for 300 to 500 machines. And as the market grows, I think we will also grow that business.
Got it. And what would be the cost of these machines? A range would be, just to get an idea.
It's 5 to 6 lakh rupees. It starts from typically 5 lakh rupees to, and then depending on the model, 5 to 7-8 lakh rupees.
Great. Okay. Sounds good. That's about it from my end. And I hope your parents are feeling better. Take care.
Oh, thanks, Devesh. Thank you. No, they are better. They just got some tests for dad, and he had some cardiac issues, but he's fine.
Okay. Thank you. Take care. Bye.
Thanks.
Thank you. Our next question is from the line of Pankaj Shah from Dinero Wealth. Please go ahead.
Good afternoon, sir.
Good afternoon, Pankaj.
Yeah. So my first question is on the congratulations on the diagnostic scheme PLI. So can you brief us more on the scheme? Like what is the timeline and what is the peak revenue and by how much time can we do that?
So so Pankaj, what we are trying to do is get into this ELISA-based kits and RT-PCR-based kits. Of course, there are a lot of players in the market, but we think that as we have the vacutainers and then we have needles where we already supply some diagnostic products to labs, and we also have VTM kits and all that stuff. So that gives us some power to go to these labs and also sell other products. And what we have seen is these diagnostic products cut across our other two verticals also. They cut across our dialysis vertical, they cut across our blood transfusion vertical. Because every blood sample which is taken is tested for HIV, hepatitis and everything. So all these products are used there. So if I'm supplying my blood bags, I'll also supply this testing, kits so that they can test the blood. Before putting into the blood bag. Similarly, in dialysis center, they do some blood tests, so they need these kits. And in also diagnostic space where we operate, sell vacutainers and tubes and needles and some other, kits, they also need these products. So what we are seeing is these products will cut across all the segments, plus we have a reach to labs and hospitals. So we are expecting revenue next year maybe 25-30 crores, and if we can grow this by 30-40% every year, because diagnostics is a very growing field, and you're already seeing this industry has grown in the last 5-7 years multifold. So I think there is a room for a company like us, which is more in organized sector, to go and sell to this. So today we sell to Thyrocare, we sell to Vijaya Diagnostics, we sell to Pathka, and so we are selling some products already there. So we can then enter with some more products.
Right. I got it. And Another question is on price rise. So of course we have taken some price rise. I'm sure that some part of the growth which we have, if I compare it year on year, is because of the price increase.
Yeah.
So I want to bifurcate that. How much would be the volume growth, and of course how much is the value growth?
See, total we have seen is around. So I think that's a good question. So I think if you look at, see, if I divide that 17% growth, 16.5, 17% growth, which we have done in 9 months, so maybe around 5-6% has come maybe to price increase, maybe around 12% would be around from volume.
Okay. And you have guided 200 to 300 bits margin improvement. That is on the EBITDA side, right, for the next year?
That's on EBITDA side, yes, that's correct.
And I'm sure, of course, we are taking some price hikes and new contracts, as you said. But if the crude is on constant rise, like how we are seeing currently, so how will be the margin profile?
So I think this is a continuous exercise in a business where you do cost-cutting measures, you do process improvements, you go for a price increase with customers. It's a constant exercise.
Right.
So there's a story which continues forever. You can't just stop saying, okay, from today I'll not increase my price.
Right.
At least you create that demand and pull towards yourself. Then the customer is coming back to you and then asking for a product even at a better price, higher price. So it's a constant, cycle. So this cycle will never stop in my view.
Okay, thank you. Thank you so much, and all the best.
Thank you. Thank you, Pankaj.
Thank you. Before we take our next question, we would like to remind participants to ask a question. You may enter star and 1. Our next question is from the line of Nikhil from Chris. Please go ahead.
Yeah, thank you for the opportunity, sir. Sir, wanted to understand, probably in few products, MRP plays an important role, if I'm not wrong, especially
correct, absolutely correct, Nikhil. Absolutely correct.
Yeah. So I understand in few products, our product quality is extremely superior, but probably the pricing is less, and that is why that is probably hampering the entry into the hospital.
You're right, absolutely. Absolutely right.
So any thoughts in regard to matching?
See, NPPA dictates that, the National Pharmaceutical and Pricing Authority, now which also oversees medical devices, it clearly dictates that you can't increase your prices over 10% a year, MRP over a year. And if you do that, you have to pay the differential to the government. So for example, if my price was 100 rupees, competitor price is 200 rupees, they put a high MRP on the product. I can next year only make 110. I cannot jump to 200.
Oh, understood.
Yeah. So that prohibits, from increasing your pricing. And you're right, but I think what is happening is one good factor is happening is that insurance is now calling the shots. Today, let's say when you go to a hospital, they say, I want a hernia operation to be done. So they'll say, okay, your package is 1.5 lakhs. Their MRP doesn't matter at all. So there's a package. So there the hospital is bound to use a good quality product at a good price. They're not looking at MRP because they're not charging now patient at MRP. They're charging the patient at the package rate. But whenever there is a itemized billing, whenever the patient is paying by cash, that is where the MRP comes into picture. For example, an NRI patient who doesn't have an insurance, he'll pay cash. Cash means out of pocket. Or some old patient who doesn't carry an insurance, old age patient, like our parents. My mother got a valve replacement, in December. But she did not have an adequate insurance, so we had to pay the differential to the hospital, and it was a cash payment.
Understood.
So there they are charging you on MRP. But wherever there is insurance coming or Ayushman Bharat, there, the whole package rate comes, and then MRP doesn't matter.
Okay, so but already yeah, sir, go ahead. Sorry.
The market is changing now. So let's say 5 years ago it was 75% MRP based, 25% insurance. Now I think probably in 5 years it's 50% MRP, 50% insurance. But in my view, another 5 years, it will be around 75% insurance and 25% MRP.
Understood. Also, sir, probably I understand we are the formidable player in the domestic market competing with the large MNCs. Are we gaining market share? Wanted to understand your sense on that. Because
yes, definitely. See, we don't want to fight in a market at the lower end of the spectrum. We want to fight at the higher end. See, the juice is at the higher end of the spectrum, not at the lower end of the spectrum. If I take a market share from a fringe player, it is not going to impact my P&L. It is going to, affect my P&L, also affect my, my branding. So today we are also creating a branding, and I think Nikhil, you have done a lot of good, you've suggested some good points. I think you have done some ground checks. So it is very important to have a very good brand and good perception about the product. And once you have that, then you can definitely give a good, run for the money to multinational companies.
Yeah. Thank you so much, sir. Sir, I actually want probably you guys to just take care of this minor things, because our products are definitely very superior. Just few points here and there probably can propel our growth in the domestic market to north of whatever we are seeing today.
Thank you, Nikhil. I think that really encourages me a lot.
Yeah. Thank you so much, sir. I'll come back in the queue. Thank you so much.
Thank you, Nikhil.
I wish you all the best.
Thank you, Nikhil. Thank you so much.
Thank you. Anyone who has a question may enter star and 1. We'll take a next question from the line of Mitesh Shah. Please go ahead.
Thanks for taking my question. Hemant, so sir, I just have a question about your consumables and the equipment both. So equipment is totally a different market compared to consumers. Size is more and the also realization is more. So can you elaborate more about the strategy of how would you sell and the how would you market and the about your MRs? Are you expect to increase for that, and what would be the receivable days difference on that?
See, I'll tell you, you're right, absolutely. The equipment business is very different. Now, what we are getting into is not pure equipment play. We are getting into products which are complementary to our current product range. So, for example, if I'm making dialysis consumables, that's the reason I'm making a dialysis machine, because wherever I sell a machine, my consumable will be used. So that is what we are trying to do. So we are not trying to get into, like, say, X-ray machines or CT machines or ultrasound machines. We are not getting into non-related business. We are only getting into equipment which will help us to expand our current consumable business. That's number one. So even if you see 3-4 years from now, it will still be 90%, 85% consumables, and it will be 10 to 15% equipments. So that is where, we are heading in that direction in next 3 to 5 years horizon, if you look at that horizon. And then in terms of receivables, I think it's not going to change, because we have a very strict policy on receivables. So our receivables average, if you see across the company, are between 65 to 70 days. And we maintain a very constant watch on that, and ensuring that they don't increase beyond that level. And only delay we see is in government sales, where the receivables sometimes become longer. But on trade business, on distribution business, our receivables are well within 40-45 days.
Got it. And the second question I have about the export market. So, every industry, every countries are looking to de-risk from the China. And I think during the COVID period, the China's overall medical device size increased from around 30 billion to 100 billion itself, because of the huge demand during the COVID time.
So they exported 220 billion masks.
No. Entire medical device industry.
No, so masks are part of medical device. I'm just trying to explain you that.
Right. So I just have a data.
So ventilators and even the diagnostic kits, all was being exported from China only. In the beginning, they were the only country which were able to scale up to that level.
Right. So my question is about that de-risking opportunities we can see substantially in the medical device as well, and we can gaining from this opportunity as well in future.
We are. So that is the reason you can see some growth, and plus Government of India's Make in India policy is also helping us. This public procurement orders which favor domestic manufacturing, that will help us in the long run. So all that impact will come step by step. You can't stop imports on day one because of healthcare products. Globally also, companies are looking at India, but of course India doesn't have an ecosystem. We only have handful of medical device companies. Today, probably there are only 1 or 2 listed companies. Only this year, I think 1 or 2 companies got listed, which are also not in the same area where we operate today, much smaller. And some other companies which were about to list did not get listed, didn't go for an IPO. So India is still very nascent for medtech. So first we have to sell brand India, then medical devices, because people don't see India as a medical device hub.
Sure.
So we are today present in 100 countries. We are trying to expand that business also. So I think as time, and we might get bigger opportunities as time progresses. We are in talks with some companies, but it takes time to mature. But I think there are good manufacturing infrastructure. So we should not be caught in a situation where we don't have manufacturing infrastructure and we can't make products. So we are thinking ahead of time. I said in the call that we have now acquired land for one more plant which will be operational in 2024-25. So we are thinking that far to ensure that we have enough manufacturing infrastructure to cater for additional demand which may come in from India or for China plus one strategy.
Got it. Thanks a lot for answering, sir.
Thank you.
Thank you. Our next question is from the line of Kamlesh from Max Life Insurance. Please go ahead.
Hi, Sati. Am I audible?
Yeah, you are.
A couple of questions. On PLI scheme, we have renal and now the second round of PLI, which is announced in diagnostics.
Sorry to interrupt, Kamlesh. If you're on a speaker mode, can you switch it to handset, please? Your voice is kind of muffled. We can't hear you clearly.
Yeah. So my question is on PLI scheme.
Yeah.
Post this second round of PLI scheme approval on diagnostic, what is the total capex for the entire PLI you would be doing?
So for renal business, I think we have a plan to invest close to around 70 to 100 crores in renal business, and maybe another around 20 to 25 crores in diagnostic business. But this is spread over 2 or 3 financial years. It's not immediate expense.
Understood. So just trying to understand what kind of IRR you would be expecting from this investment, or at least if you can share some sort of margin in, let's say, post 3-4 years, you'll be reaching in these two businesses on a steady state basis.
See, again, when we look at overall business, let's say, as I told you, we are looking at a better quarter, let's say quarter 4, 8 to 10% growth. So if we did 220 crores in quarter 3, we are looking at around close to 240 crores in quarter 4. So overall, we are looking at a standalone revenue of 875 crores plus in this financial year. So out of that, currently, the renal only contributes 60 crores. So it's still a very small business for us comparatively. And diagnostic only contributes around 15 crores as of now. But as we move on, I think it will probably take 2 to 3 years to really see the real, revenue IRR coming into this business. But because it's an import substitute business, especially renal business, and plus government putting a duty now in this current budget of around 14%, 7.5 plus 5% LSS. I think there we will start. See, currently it was just to gain market share and come into a new business, new line, and to develop the products, which are completely import substitutes. It is going to take a while to, maybe make this business more profitable. But in overall scheme of things, I think we'll continue to improve margin as we achieve more volumes, economies of scale, and once we double or triple our production, I think in year 3 we're looking at around from now till let's say 2025, we are looking to cost around 150 to 200 crores in renal. I think that is where we will see good steady margins, maybe close to around 50 to 20% of EBITDA margins coming in this business.
Fair enough, understood. And sir, just my next question on the syringe business, which you mentioned. How big is that opportunity for you?
So syringe is a very large business portfolio, and I think one is vaccination, one is curative markets. So this is a very large portfolio, and then we also do pre-filled syringes. So pre-filled generally is an import substitute in India. We are the only manufacturer in India today for pre-filled syringes, which is used for flushing. And Becton Dickinson is the only company which is selling in India, which is importing it. And we see a huge global opportunity for this product, especially in Europe and in nearby countries, even in South America. So we have started exporting already. And then this vaccination syringes depend on Government of India's vaccination program. So we have now visibility up to next 6 months to sell to the government. And then it depends how government wants to look at the third dose of booster, whether they want to do it, not do it. And if they want to open it to general public, then the demand continues. Otherwise, we'll move the same line into curative market. So there is also very limited players in syringes space for curative market. Like Dispo-1 is the only market leader with around 2/3 market share. So there is enough ample room for a new player to come in and expand capacity. So India probably is like 1,000 crore syringe market. Globally, it runs into billions of dollars, and we are a company which exports also globally. So there is an opportunity everywhere.
Understood. How much of this opportunity, this government vaccine opportunity, would be there in this particular quarter?
quarter, this particular present quarter, I think we are spending close to around 2 crores ranges to the government, 2.5 crores, 75 lakhs a month.
Okay, 75 lakh rupees in a month.
Yeah. Which at one point of time was number of vaccinations done in a day.
And for the export opportunity in this particular field, how would the capex entail? Would there be further capex or?
So this is a constant. So if there's a demand, we will invest in more expanding the capacity. Depends on how we get demand from overseas markets. So we have to get brand registration, product approval. And then when they come through, we will continue to expand. Today customers are coming from far off countries, and they want to in Europe they want this product. Definitely expand capacity because we have a pipeline of customers. The only thing you have to put more products in the same funnel.
Understood. So just a little clarity, considering we have PLI and all these opportunities along with the animal healthcare business which you just mentioned. Next year, 20% top line growth which you just kind of stated. Just trying to understand beyond FY23, how should we look at this growth? I mean, do we have any clarity? Because
we have not given any guidance, ma'am, for further years. But yes, if we are, teaching between 18 to 20% growth between now and next year, I think that same momentum should continue. And plus, Indian market expanding with PLI coming in and with export business growing, more products coming in. At least the stage we are in, I think we should easily be able to reach that 18-20% growth every year. I think that is probably the minimum we should be doing.
Understood. Sir, my last question would be on margins. If you could just help us understand some sort of guideline with respect to maybe 3 years or 5 years perspective.
I don't have visibility on that, ma'am. It depends so much on the current. If crude oil becomes $200, all my projections will be going haywire. So I think it's a very long haul to say that. But I think if we continue in that 25% band on EBITDA plus minus 1, 2, 3%, I think we are good.
Understood. Thank you so much.
Thank you.
Thank you. Our next question is from the line of Girish Jain from KJMC Capital. Please go ahead.
Thank you for the opportunity, and happy to learn that your parents have recovered from the COVID infection.
Thank you, Girish.
Mansuji, my question, I have 2 questions.
Yeah.
We had raised, I think, 400 crores last year.
Yeah.
How is the cash position and how is the debt position now? If you can just.
So, Girish, currently we hold. So we also had other than 400 crores, we also had more cash in the company. So currently we have around 375 crores in cash, which is earmarked for capex expenditure and for other opportunities. And I think we have around close to 75 crores of long-term debt, which is all in foreign exchange, which is between 1.5 to 2%. So that's the reason it's not been retired and it still is in the company.
Okay. And
long term. Then we also have around 45 crores of working capital debt, which is also mostly in foreign currency.
Okay. That also foreign currency.
Yeah.
And you mentioned about the new capex. So if I just if I can just get some clarity, I think Faridabad unit number 3 will go on stream in somewhere in July 22.
Yeah. So there are one plant in SEZ, which is, and we are expecting both the plants to be partially operational by October 2022. And then full operation will start probably in maybe Q1 of FY24. But in this Q3 of this next financial year, they should be partially operational. We will do this to start some production in this plant.
So this is the Faridabad 3 and Jaipur SEZ number 2, right?
Yeah, correct. Faridabad is number 4 and SEZ number 2.
Okay, SEZ number 2. And you also mentioned about further new capex for which you have bought the land.
Yeah.
Where is that likely?
It's also in Faridabad, and this plant basically it's a bigger land. We will be probably looking at establishing sterilization facilities and maybe expanding more into dialysis business. Maybe we need it for manufacturing, expanding the dialyzer capacity or machine capacity. and that's the reason. Looking at what we see with Make in India focus, I think there pop in demand for these products.
So Faridabad 5 will be for sterilization and dialysis, if I understand.
Yeah, more in that direction.
Okay, thank you and all the best.
Thank you, Giriji. Thank you.
Thank you. Anyone who has a question may enter star and 1. As there are no further questions, I would like to hand the conference over to the management of Poly Medicure for closing comments. Over to you, sir.
Thank you very much for all the participants. I think there were a lot of good questions and I think some good ideas for me. So, and I would definitely, consider some great ideas I've today, heard from people. And thank you and look forward to stay connected with you. And I think these points really help us to improve further and deliver better to our shareholders and to our customers who are, patients in the hospital. So thank you again for your support and all the best. Thank you.
Thank you, members of the management. Ladies and gentlemen, on behalf of ICICI Securities Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your line.